Ever noticed how the government, well, subtly tries to guide your financial decisions?
Mm,
Maybe nudging you towards, say, an electric car or encouraging that renovation of a historic building downtown?
yeah, those little nudges.
Well, you're picking up on something real. Today, we're taking a deep dive into the fascinating world of 2026 tax credits and also the payment procedures that, keep our financial system running.
It's a big topic.
It is. Our mission for this deep dive is pretty straightforward. We're going to pull out the most important nuggets of knowledge, explain how these credits work, why Congress even uses them, and maybe most importantly, what they could mean for you.
Right.
Whether you're running a business, you're an employee, or working for yourself. Forget the dense tax manual, okay? Think of this as your shortcut to being well informed.
Exactly. And it's really crucial to understand that tax credits are much more than just a way for the government to, collect revenue.
Right.
They're incredibly powerful tools. Congress uses them to achieve specific social, economic, maybe even environmental goals, and often to make the tax system feel fairer.
Okay.
What makes them so uniquely impactful is that they offer a direct dollar-for-dollar reduction of your tax liability. It's not a deduction, it's literally money off your final bill.
Okay, let's unpack this a bit more then. What's the big picture here? I mean, why do these tax credits even exist? What's Congress really trying to achieve by, building these into the tax code?
Well, think of tax credits as policy levers. Congress uses them to incentivize behaviors that they think benefit society.
Okay, like what?
So on the social side, for example, you've got the disabled access credit. That encourages businesses to make their places accessible, maybe renovate an older building to comply with the Americans with Disabilities Act. It's really about fostering inclusion.
Got it.
Then, economically, credits like the research activities credit, that pushes for innovation right here in the U.S.,
Mm.
drives advancements in high-tech, clean energy.
So encouraging specific industries.
Exactly. And these tools, they're far from static. They
Mhm.
constantly evolve with our economy and, well, the political landscape.
It's quite intriguing how different they are from deductions, though. You mentioned that dollar for dollar thing. With the deduction, the benefit really depends on your income bracket, right?
Mm,
But with a credit, if you qualify and you have enough tax liability, it's equally valuable to you, whether you're a tiny startup or a huge corporation. That seems to level the playing field quite a bit.
it absolutely does, and that's precisely why they're so effective.
Oh.
Because it's that direct dollar-for-dollar reduction. The incentive is incredibly clear and powerful.
Hmm.
It's not just about reducing your taxable income. It's about reducing the actual tax you owe.
Which feels much more direct.
Much more tangible impact, yeah.
So, okay, if a credit is a credit, sounds great. What's the catch? Because here's where it gets, I think, really interesting. Not all credits are created equal, are they? Let's talk about that key distinction. Refundable versus non-refundable.
That's a critical distinction to grasp. Absolutely. So imagine two types of credits.
Okay.
Refundable credits are, well, the most generous if the credit amount you qualify for is more than the tax you actually owe.
Yeah.
The government pays you the difference. It's essentially a refund that goes beyond any taxes you might have already paid in. The
Yeah.
earned income credit is a classic example.
Ah, okay. So you can actually get money back from the government even if you owed zero tax to begin with.
Precisely. Now, non-refundable credits, on the other hand, they can reduce your tax liability right down to zero, which is great.
Still good.
Still very good. But any amount exceeding that zero liability, it's generally not paid out to you.
So it just disappears.
Not always.
Yeah.
Some non-refundable credits do have a silver lining.
Yeah.
They can often be carried over to future tax years.
Huh.
Others, though, yeah, they're simply lost if you can't use them in the current year. So you have to pay attention to the specific rules.
That makes a huge difference in planning, I bet. Now, for businesses, you hear this big umbrella term, the general business credit. If a company qualifies for, say, 3 or 4 different credits, does the IRS just let them stack up indefinitely? Or is there some system to manage that?
That's a great question. And it's exactly where the general business credit comes in. It acts as that very system.
Okay.
It's basically a combination of numerous individual business credits, each one calculated under its own specific rules. But then they're all combined into one sum. The main purpose here is really to put a limit on how much total business credit a taxpayer can use to offset their income tax liability in any single year. It ensures a kind of balance.
So it stops things from getting out of hand, credit-wise.
You could say that, yeah. This umbrella, it covers a really wide array of incentives. Things like credits for rehabilitating historic buildings, for hiring specific employee groups, investing in R&D, even adopting green energy solutions.
Wow.
A key benefit for businesses, though, is that if they have unused general business credits, they can actually carry them back 1 year to get a refund on past taxes,
Oh, interesting.
and then carry them forward for up to 20 years. So this mechanism helps maximize their value over a long period.
20 years is a long time. Okay, let's dive into some of these specific business credits then, because these are, like you said, really fascinating examples of how the tax code tries to literally build a certain kind of economy and society. What are some of the most impactful ones? What kind of world are they trying to create?
It's true. Each one is almost like a mini policy statement baked into the tax code.
Yeah.
Take the tax credit for rehabilitation expenditures. Think about, a local developer looking at that beautiful but kind of dilapidated old building downtown.
Mm.
This credit is designed to make revitalizing it financially appealing. Helps prevent urban decay, preserve historic structures. It offers a 20% credit for qualified expenses on certified historic structures.
20% is significant.
It is. And the interesting part is that the building's tax basis, its value for tax purposes, is immediately reduced by the full credit amount. So effectively, the government is kind of fronting a portion of that preservation effort.
Right. Reducing the future tax benefit of depreciation, but giving cash flow now.
Exactly. Then there's the Work Opportunity Tax Credit, often called WOTC. This aims to help people who face significant barriers to employment.
Okay.
It encourages employers to hire individuals from certain targeted groups like, say, the long-term unemployed, qualified ex-felons, veterans, SNFP recipients.
So helping specific groups get jobs?
Precisely. The credit reduces the cost of hiring these individuals, helps them get back on their feet and into the workforce. And beyond just the tax saving, companies often report things like enhanced workforce diversity, a deeper connection to their community. It can be a dual benefit.
Yeah, I can see that. What else?
The research activities credit, the R&D credit, this is crucial for innovation.
Always hear about this one.
Yeah, it's all about encouraging businesses to invest in research and experimentation right here in the U.S. Eligible expenses include things like wages for research staff, costs for supplies, even payments for contract research.
Okay.
It has different ways to calculate the credit, including an alternative simplified method, all designed to make it more accessible for companies, big and small, to innovate.
Good. And for the smaller guys.
Right. For small businesses, the Disabled Access Credit can be incredibly helpful. Its purpose is pretty straightforward. Help them comply with the Americans with Disabilities Act.
ADA compliance. Okay.
It covers a portion of eligible expenses for things like installing ramps, widening doorways, maybe purchasing equipment to assist visually, or hearing impaired employees or customers.
That seems really practical.
It is, and this isn't just about compliance. It's about making businesses more inclusive without putting a huge financial burden on smaller operations.
Makes sense. And energy. That's huge now.
Absolutely.
Yeah.
The energy credits for businesses are a major focus right now. These are all about incentivizing alternative energy use, reducing carbon emissions, producing cleaner fuels, the whole green transition.
Right.
Many of these credits are designed with bonus features, too. For instance, the credit amount could increase significantly if you meet certain prevailing wage and apprenticeship requirements.
Ah, linking it to labor practices.
Exactly. Or if you source your steel and iron domestically. There are even bonuses for projects in specific energy communities, like areas affected by coal plant closures.
Wow. Very targeted.
Very. And maybe the most exciting development with some of the newer Inflation Reduction Act energy credits is the option for direct payment from the government, or even the ability to sell the credit to another taxpayer.
Wait, sell the credit. How does that work?
It essentially turns these tax credits into immediate cash flow. It makes green tech investments much more accessible, even for businesses that might not have enough tax liability to actually use the credit themselves. They can sell it to someone who does.
That last point about direct payment and selling credits, that really is a game changer.
It really is.
It's amazing how specific these incentives can be, guiding businesses towards everything from hiring practices to preserving old buildings or jumping into green technology. It really feels like a dynamic roadmap for, well, desired societal and economic outcomes.
That's a good way to put it.
Okay, now let's pivot a bit.
Okay.
From businesses to, well, you, the individual taxpayer listening, Many of us can directly benefit from tax credits that impact our daily lives. And you mentioned international ties earlier. There's a crucial credit there, too.
Absolutely. These credits are really designed to support a wide range of personal circumstances and goals.
Okay.
Let's start with that international angle.
Mhm.
The Foreign Tax Credit, or FTC.
Okay.
Its main goal is pretty simple. Prevent double taxation. If you're a U.S. taxpayer earning
Yeah.
income in a foreign country and paying taxes there, this credit allows you to directly offset a portion of your U.S. tax liability for those foreign taxes you paid. It helps ensure fairness and encourages international business without penalizing income earned abroad. You generally can't use it to reduce your U.S. tax below what it would be on just your U.S. income, but it avoids paying tax twice on the same foreign income.
Got it. Prevents being taxed twice. Makes sense.
Closer to home, the Earned Income Credit, the EIC, is a really significant benefit for working individuals and families with low to moderate incomes.
We mentioned this one with refundable credits.
Exactly. It's refundable, meaning if it reduces your tax liability below zero, you could actually get a refund check. The amount you receive depends on your earned income and how many qualifying children you have. It's truly designed to help lift working families.
A major anti-poverty tool.
Definitely. Then we have the Child Independent Tax Credits. These aim to help manage the significant costs of raising families.
Tell me about it.
Right. The Child Tax Credit offers a pretty substantial amount per qualifying child under 17, usually a dependent, and a portion of it is refundable, providing a direct boost to family finances.
And for other dependents.
Yeah.
Like an elderly parent.
Yes, for non-child dependents could be an elderly parent, an adult child with a disability, other relatives. There's a smaller non-refundable credit available. Both of these credits, though, do start to phase out for higher earners. They look at your adjusted gross income, that's your income after certain deductions, and if it goes above a certain level, the credit amount starts to decrease.
Okay, so targeted more towards middle and lower incomes.
Generally, yes. Complementing that is the Credit for Child and Dependent Care Expenses. This credit helps offset costs you incur to care for a dependent so you can work or look for work.
So this is for daycare, after-school care, that kind of thing.
Yeah, exactly. It's a percentage of those expenses, up to a certain maximum amount per dependent. And the percentage you receive actually varies. With your income, lower income gets a higher percentage. This is specifically for when you need that child care or dependent care support to be able to participate in the workforce. You need to have earned income to claim it.
Right. Makes sense. What about education? Always expensive.
Very true. There are two key education tax credits here. The American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit.
Okay, what's the difference?
The AOTC is generally more generous but more restrictive. It's geared towards the first 4 years of post-secondary education college, essentially. It can even cover required books and supplies. The Lifetime Learning Credit is more flexible. It covers any level of post-secondary education or vocational training, even just one course, and there's no limit on the number of years you can claim it.
So AOTC for undergrad, lifetime learning for maybe grad school or job skills.
That's a good way to think about it, yeah. Both are designed to make education more affordable, but like the child credits, they also have income phase-outs to target the benefit towards low and middle income individuals. And you can't deduct expenses you've claimed a credit for.
Got it. No double benefits. What about home stuff? Energy efficiency.
Yes, the residential energy credits. These are all about making your home more sustainable. There's one credit, the Energy Efficient Home Improvement Credit, for things like installing energy-efficient windows, doors, insulation, or maybe a heat pump in your primary residence. It's a percentage of the cost, up to an annual limit.
Okay, for upgrades.
Right. And then there's the Residential Clean Energy Credit. This is for bigger ticket items like installing solar panels, wind turbines, or battery storage on your principal residence. It's also a percentage, currently 30%. A key feature here is that if the credit is more than the tax you owe, you can actually carry the unused portion forward to future tax years.
Oh, that's useful for big projects like solar.
Definitely. It's Congress's way of saying, go green, make these investments, and we'll help ease the long-term cost. Though, keep an eye on the percentages. They are scheduled to step down in 2033 and 2034.
Good tip. And cars, the electric vehicle push.
Big credits there, too. We have the clean vehicle credits for both new and used electric and plug-in hybrid vehicles. For new vehicles, there's a credit up to $7,500, but it comes with a lot of strings attached.
Like what?
Things like where the vehicle underwent final assembly needs to be North America, the battery capacity and sourcing, the manufacturer's suggested retail price caps.
Wow, complicated.
It can be. There are also limits based on the buyer's modified adjusted gross income, that's your AGI, with a few things added back. But a neat feature is you can often transfer this credit directly to the dealer at the point of sale, effectively getting an immediate discount.
That's handy. What about used EVs?
Yes, there's also a credit for previously owned clean vehicles. It's smaller, up to $4,000, calculated as 30% of the sales price, and it has different requirements. The vehicle must be at least 2 years old, cost $25,000 or less, and again, there are buyer income limits. It's designed to make sustainable transportation more accessible in the used market too.
Okay, covering both new and used. Anything else for individuals?
One more key one: the credit for certain retirement plan contributions, often called the Savers Credit.
Ah, for retirement savings.
Exactly. It encourages lower and middle-income taxpayers to contribute to qualified retirement plans like IRAs and 401ks. It's a non-refundable credit, but it gives you back a percentage of your contribution, up to a certain amount. The percentage depends on your income and filing status. It's really aimed at helping boost those early savings efforts for people who might find it harder to save. You have to be 18, not a dependent, and not a full-time student, generally.
So trying to encourage saving even for those with modest incomes.
That's the idea.
Okay, wow. If we connect all this back to the bigger picture, it's really clear that these individual credits are strategically designed. They seem to support life's major expenses, raising families, getting an education, making your home more sustainable, planning for retirement. They're really trying to help you, the taxpayer, with those big financial milestones.
I think that's exactly right. They target key areas where financial support can make a real difference in people's lives and decisions.
So we've talked about all these fantastic ways to potentially reduce your tax bill with credits, but let's shift gears slightly. How does the government actually collect the money throughout the year? It's all about that pay-as-you-go approach, right? How does that actually work in practice?
Exactly. The U.S. tax system is fundamentally built on a pay-as-you-go principle. The idea is taxes are collected as income is earned, rather than in one massive lump sum at the end of the year.
Which would be painful for most people.
It's extremely painful, yes. So this happens primarily through two main channels: employer withholding for employees and estimated tax payments for the self-employed and others with income not subject to withholding.
Okay, let's start with employees. Most listeners probably fall into this category.
Right. For employees, your employer basically does the heavy lifting for you.
Thankfully.
Yes. They are required to withhold amounts for Social Security and Medicare taxes. These are the FICA taxes from each paycheck. And importantly, they also have to match the employer portion of those FICA taxes.
Okay.
Then they also withhold your federal income taxes. Your form, W-4, is key here. That's the form you fill out when you start a job. It tells your employer how much income tax to set aside based on your filing status, dependents, other income deductions, etc.
So getting that W-4 right is important for accuracy.
Very important. It ensures your tax obligations are gradually met throughout the year, hopefully avoiding a huge bill or a massive refund come tax day. There's also a mechanism called backup withholding, usually at 24%, that applies sometimes to payments like interest or dividends if, say, a correct Social Security number isn't provided to the payer. It's another way to ensure taxes get collected.
Got it. So that's employees covered by withholding. What about small business owners?
For self-employed individuals, the responsibility really shifts onto your shoulders. If you expect to owe at least $1,000 in tax for the year, and any withholding you might have from other jobs won't cover at least 90% of your current year's tax liability or 100% of your prior year's liability.
Okay, there's a rule.
Yes, there's a threshold. Then you're generally required to make quarterly estimated tax payments. These payments cover both your income tax and your self-employment tax.
Self-employment tax, what's that exactly?
That's how self-employed individuals pay their Social Security and Medicare taxes. Since there's no employer to pay the other half, you pay both the employee and employer portions. For 2025, that's 15.3% on net earnings, up to the Social Security wage base, $176,100, and then 2.9% for Medicare on earnings above that. The good news is you get to deduct 1/2 of your self-employment tax as an adjustment to income.
Ah, okay. So it covers Social Security and Medicare, and these estimated payments are due quarterly.
Yes, typically April 15th, June 15th, September 15th, and then January 15th of the following year for the last quarter's income. If you underpay your estimated taxes throughout the year, you can face penalties. So it's important to estimate your income and tax liability reasonably accurately.
Right, need to stay on top of that. Any other wrinkles in the payment system?
Well, for high-income individuals, there are a couple of additional Medicare taxes to be aware of.
Hmm.
First, there's an additional 0.9% Medicare tax imposed on wages and self-employment income that exceeds certain thresholds, $250,000 for married filing jointly, $200,000 for most others. Your employer withholds this if your wages exceed $200,000, but you might owe more depending on your spouse's income or self-employment income.
So an extra bit for high earners towards Medicare.
Correct. And second, there's an additional 3.8% tax on unearned income, often called the net investment income tax, or NIT. This applies to things like interest, dividends, capital gains, rental income for higher income taxpayers. It generally kicks in if your modified adjusted gross income exceeds those same thresholds, $250,000 married, $200,000 single.
So high earners potentially face extra taxes on both earned and unearned income?
That's right. These ensure that those with greater financial capacity contribute proportionally more to these essential programs.
Okay, so understanding these procedures, withholding, estimated taxes, the extra bits, it isn't just about, ticking boxes for compliance. It sounds like it's really about smart financial planning throughout the entire year.
Absolutely. It's about managing your cash flow and avoiding unpleasant surprises or penalties. Being aware of how these taxes are flowing out of your accounts or how they should be flowing out is critical.
Right, rather than just waiting until April and hoping for the best. Okay, so with all this information now about the credits themselves and how taxes get paid, how can you strategically use this knowledge to your advantage? Let's talk about some key tax planning opportunities that arise from all this.
This is where understanding the rules can really pay off. For instance, let's go back to the child and dependent care expenses.
Okay.
If you have employment-related care expenses like daycare so you can work up, that might also technically qualify as medical expenses, perhaps for a child with special needs.
Right, I could see that overlap.
You actually have a strategic choice. You can claim those expenses towards the child and dependent care credit, or you could potentially deduct them as medical expenses if you itemize deductions and exceed the 7.5% AGI floor for medical expense.
But which is better?
It depends on your situation, your income level, the amount of expenses. But here's a potentially savvy move. The child care credit has dollar limits. $3,000 for one child, $6,000 for two or more. If your qualifying expenses exceed that limit, you can claim the credit up to the limit, and then the excess amount might still qualify as medical expenses. So you could potentially get a partial benefit from both.
Ah, interesting. Getting the most out of those dollars. What about managing the payments themselves, withholding and estimated tax?
Definitely opportunities there. A crucial one is adjusting your withholding strategically. Let's say you realize mid-year that you're going to owe a lot more tax than expected, maybe due to some freelance income you didn't plan for,
Yeah.
and you're worried about underpayment penalties for estimated tax.
Yeah, that happens.
If you're also an employee, you can often catch up by significantly increasing your income tax withholdings from your paycheck late in the year.
How does that help with earlier underpayments?
Because the IRS generally treats income tax withholding as if it were paid evenly throughout the year, regardless of when it was actually withheld. So, boosting your withholding in November and December can effectively cover shortfalls from earlier quarters and help you reduce or even eliminate those underpayment penalties.
That's a really useful tip, kind of a loophole.
Well, it's how the rules work for withholding.
Mm-hmm.
The flip side is also important, avoiding over-withholding.
Giving the government an interest-free loan, as they say.
Exactly. If you consistently get huge refunds, it means you've had too much tax withheld throughout the year. If you expect large itemized deductions, maybe significant business losses that flow through to your return, or substantial tax credits like those clean vehicle or education credits we talked about, you should definitely take action.
How?
Use tools like the IRS's own tax withholding estimator online. It helps you figure out the right amount to have withheld. Then you can file a revised Form W-4 with your employer to adjust your withholding accordingly.
So you get more money in your paycheck each period instead of waiting for a refund.
Precisely. It's about better cash flow management, keeping more of your money working for you sooner.
These are fantastic insights. It really shows how being informed isn't just about filling out forms correctly at the end. It's about making strategic choices all year long that can genuinely impact your bottom line. It's not just about compliance, is it? It's really about control.
That's a great way to put it. Control and optimization.
Okay, so to wrap up our deep dive today, I think the core takeaway is this. Tax credits are incredibly powerful policy tools. They're not random. They're specifically designed to incentivize certain actions for social good, economic growth, environmental benefit, and they directly impact both businesses and individuals like you listening right now.
Hmm.
Understanding the nuances, refundable versus non-refundable, the huge array of specific incentives available, and just the basic importance of proper payment procedures throughout the year. It isn't just academic tax stuff, it can significantly affect your financial well-being.
Absolutely. Knowing these details really empowers you to make informed decisions, whether it's about making a business investment, considering a new clean vehicle purchase, planning for your family's future education costs, or even just optimizing your paycheck withholding throughout the year. This knowledge really puts you in the driver's seat.
So here's a final thought for you to chew on. As you think about your own financial plans for 2026, consider not just your income, but how your actions and choices might align with these tax incentives. What small change could you maybe make? Could be a home improvement, a retirement contribution, maybe even a hiring decision in your business that could yield a surprisingly large benefit, both for your wallet and maybe even the world around you.
Food for thought?
Definitely. Keep exploring, keep thinking critically about how these tax policies shape our world and your finances.